Welcome back to Gimme Some Truth. I'm here with Mitch in the booth talking about cash today. I am Nate. We are tackling the subject, which is a little bit of kind of a, almost feels like kind of a no-brainer, but we've seen a lot of people stumble, I'll say, over the last maybe 12 to 18 months on what to do or what not to do with their cash.
It's something that we see all the time. It happens weekly, if not daily, in conversation, I think, with clients or prospective clients. And sometimes we think of, we need to find this next exotic podcast topic.
Right.
And when we were prepping for this a day before recording, we're like, you know what, let's just do something that probably gets overlooked. So we're going to talk about cash. And there's all sorts of things that come along with it. It sounds simple, but I think we can fill a podcast here.
Well, I think ultimately what it comes down to is the world's way different today than it was, to be fair, it's way different over the last couple of years than it was for literally the decade prior to that, right?
Yes.
And so I think in fairness to the people listening and watching, if you haven't done anything with your cash, it's not that you've missed the boat for a 10-year period, but it's different now than it was for the majority of, call it 09 to 2021, 2022, somewhere in that neighborhood. We're actually getting paid now, but you have to be active to get paid.
Yeah, you have to make a decision.
You have to make it happen.
You have to make a decision. And sometimes it's as simple as that, right? A lot of people look at us as investment advisors, and there's this thought that we're just going to say, of course, you got to invest your cash. And that is not what we're saying. There are certain times where it does make sense to deploy your cash in stocks, bonds, et cetera. But sometimes it's as simple as I'm getting 0.0 nothing, I'll say, on a wad of cash in a checking account. And sometimes you got to either call your bank or log in on, sometimes you can do it from your phone, literally just shift money from something that's paying you nothing to paying, over 3% or so now in a high yield savings. But you're exactly right. There's a decade where you couldn't get paid on your cash.
It kind of didn't matter where it's at.
Didn't matter. Checking and saving even were pretty close, and you just got pennies or dollars maybe on your cash in the bank. So I think in this conversation, we can define cash as what's sitting in checking account, savings account. We can kind of clump money market or CDs, and we can talk about the pros and cons of when we might want to use some of those things. And then there are going to be times where, we might take a look at someone's individual situation, and based on their needs and timelines and all that stuff, you might actually want to invest some of that cash.
So let's unpack this a little bit, Mitch. So let's say somebody's sitting, and we'll just make the math simple, right? So let's say somebody has $100,000 in cash, okay? And paint a scenario where it's sitting in a savings account, as we like to tongue-in-cheek say, 0.0 nothing. If it's getting, what happens at the end of 12 months if they move to a high yield savings account, for example? I mean, help people understand what that would look like. Yeah,
let's say you're sitting on $100,000 in that account, and you're getting the 0.0 nothing. You literally might see pennies of interest. You don't even see that transaction when you log into your bank account. Let's say you shift even numbers, $100,000 exactly, over to your high yield savings account. There's many places you can do that. Mine is at Ally Bank, for example. This is no big endorsement for that. That's just where I do my checking and really all my banking. But they're paying 3.4% currently at the time of this recording. So that's $3,400 on an annual basis. And it's not just dropped in there one time on December 31st, right? It's something that you get paid monthly. So you get a little bit of interest paid monthly, and it's just deposited in the account. So we're talking hundreds of dollars, every month that goes by, that money is then sitting in that high yield savings account. It's still liquid, accessible. I can transfer it to my checking very easily, almost instantaneously, actually. I press a button, boom, done.
And that would be kind of what we would refer to as kind of the first level, right? Or kind of this is the first move that you would make. And we're not suggesting that people have zero balance in their checking. You're going to have some working cash, right? But what you're sitting on, it's real money, right?
Yeah.
And that's kind of what we tend to refer to in our office is it real money? Maybe a $50 difference one way or the other. Maybe kind of who cares? But $3,400 in your example, that's starting to get to be real money. And I think that that's what people are sacrificing by not having money sitting here versus here. Let's move on to, like, say, treasuries or even, the short-term higher yield bond funds that we're dealing with. I mean, help the listeners and the viewers understand what that looks like. Not a great deal additional interest, but can be at least 1% more in some cases.
For sure. And I think before that, the decision you need to make is how much is an appropriate amount of cash. And we help our clients with that all the time, right? Because then it's, all right, well, how much am I sitting and checking? How much is in savings? And then maybe you do use something like a treasury. I know some people use T-bills for knowing when their property taxes are due, right? Because then maybe you can get 4%, let's say. And okay, by the time that thing matures, I put it towards my property taxes, because every year, right, we know we gotta pay some of those things. So when it comes to treasuries, yeah, you can maybe do a little bit better, right? 10-year at the time of this recording, floating a little over 4. So that obviously is higher than the 3.4 I said in that previous high yield example. But what does that come with, right? Well, usually your money's going to be locked up. You can hold it till maturity. You could sell it, right? You can get rid of it. But it's not quite as liquid as if you just have it sitting in your good old FDIC insured savings account. But that might be worth it in some cases. If there's a known time when you need some cash, whether it's property taxes, like I said, or some people it's a down payment for their kitchen remodel, right? I need $50,000, let's say, by whatever date. Okay, cool. If something matures right before that time, I can deploy the cash. Awesome. That's just one use. We could do something like that.
So Mitch, one subject that we touched on a little bit, but didn't necessarily get deep into is kind of more the idea of liquidity, risk when it comes to cash, how to kind of layer these things out. I mean, how do people tend to make those decisions?
Yeah. So it's going to be looking at when you might need cash. And if the answer is like, no, I don't need anything for the foreseeable future. One of the questions that we ask is, do you have any big expenses coming up in the next 18 months?
Yeah.
Right. Now, that's a slightly different question than what we were talking about earlier, where, you lose your job, like you need an emergency rainy day fund, right? Yes. But then beyond that, known expenses, things that are in your control. And if you don't need it for 18 months, 2 years, 3 years, that's when you can start to explore some things to do with your cash that maybe you don't need that same day liquidity, like transferring from your savings to your checking account. Sometimes a lot of people that come to us, they say, I can lock it up in a CD that's paying 4%. Sure, you could, right? Yep. That's absolutely something you can do. Other times people don't understand the liquidity that they have even in their own brokerage accounts.
Sure.
So a lot of times our job is providing some education there that, hey, you got your retirement savings, let's say, and let's say that you're someone that is still a decade plus away from retirement, kind of a long-term investor, because someone in retirement might treat this a little differently. But let's say that you're a long-term investor and you're used to putting money in your 401k, you plan on not touching it for a very long time. And sometimes they associate that the same as their taxable brokerage account or trust account, however it's titled.
Yep.
And that is a good mindset to have, because generally speaking, when you invest, you want to have a long-term approach.
Yeah.
However, as we all know,
things happen.
If you need to dip into that taxable brokerage account, you can do that penalty-free. You can't necessarily do that tax-free, because we might have to sell some securities to free up the cash to then send it to you. But it is pretty liquid to the form of 2 business days, assuming the market is open.
Yeah.
Right. And we can get clients that cash, and we've had to do that for clients when things happen.
And that's, I think, that next level of conversation, right? Because you're exactly right. There's a difference between risk and liquidity. Brokerage accounts offer liquidity, but they are not risk-free assets like a money market would be or high yield savings, right? So that, again, it's kind of that layering idea of, we still want to make sure that we have plenty of money in our, I can get to this literally, no risk, and I can get to it in, within a day, right? And then that next layer is typically a brokerage account where we are investing some of that money, maybe not the same way we would invest IRAs and 401ks, but that kind of midterm position. And even within that account, we're still probably using some pretty safe bond investments and things like that to balance the risk, right? So
could be really short-term treasuries, for example, get a little extra yield.
Yeah.
One thing that we've done with clients too is I get a phone call. They say the car got totaled, right? We're in the market for a new car. Okay, let's actually shift some money around. Let's maybe in a year like this year, actually, you could take some wins while the market's up, sell from some of those stock positions. Sure, there's a little taxable gain, but then just shift the amount needed over to money market. And then during that waiting period until you get the green light, hey, we need the funds for the car. Great. We'll then send it from the money market.
Yeah. And I think that also is a good kind of pivot or juxtaposition too between that and other fixed products. You mentioned CDs, and there's other fixed products out there that can give us a fixed rate of return and in some cases a better rate of return than say a high yield savings or something like that. However, it does limit our liquidity. Yes. And I think that's one thing people have to be careful with is they can fall in love with a yield and this almost kind of surprisingly, wow, I can get a guaranteed, make up a number, 5% or 5.25 or whatever it is. And they go, great, I'll take that because it's better than a high yield savings at 3.5 or whatever it might be. But how long are we locking that money up for? Does it require a 3, 4, 5 year, fixed lockup period? If it is, we want to be a little careful with that. It's not that we shouldn't do it, but we just understand that little additional yield to give up all of our liquidity might not be the best decision for some people.
And sometimes, too, speaking of that, just chasing the yield, I see this with the people that are following NerdWallet and like, oh, this month in October of 25, SoFi is paying me 3.5%. Therefore, I should send everything over to SoFi. And that's just not me. I get it. If you're someone that's sitting on a ton of cash for whatever reason, maybe that is thousands of dollars or something. That's a whole different conversation because I would make an argument you should be doing other things with that cash. But I'm not one to chase yield because these things change.
Right.
Fed's cutting rates. What is one of the first places that gets affected? Well, high yield savings, right? These banks are cutting from, you could get over 4 easily in a high yield savings just last year, earlier this year for that matter. Then it trickled down to 3.7. Oh, Fed cuts rates. We're down to 3.4, right? And as long as you're not getting the 0.0 like we were talking about earlier, if I'm getting 3.4 versus 3.5, for me personally, that's going to be good enough. I'm not going to shift over all of my banking to chase yield that is subject to change.
Right. And very well could be almost like a teaser rate that the institution is using just to try to gather assets, which may be temporary. So I think you're right. I think there's kind of good sound cash management kind of methods and strategies, but don't make a career out of this of moving your money every 3 months to chase another 0.25% or something like that, because that starts to become where we're just spinning our wheels and we're not getting anything out of it. So I think ultimately it's trying to make smart decisions with it, but at the same time, not getting lost in the noise of it. And I think that cash is, in a lot of ways, it's a subject that can be kind of overlooked, and a lot of our clients and a lot of people out there have kind of almost not taken it for granted, but I think it's just gotten almost forgotten. And I think the world's a little different now than it was, say, 3, 4, 5 years ago. And we need to pay a little bit more attention to our liquidity, how much we're keeping, what's our maximum yield, where we're at. And then sprinkle in the softening, if you will, of the job market. And this subject it's more relevant, I think, today than maybe it was, say 3 years ago. And so we hope you found value in this podcast. If you want to hear more about this, or you want to talk about your situation specifically, please book an appointment with us, and we'd love to go through that with you. And if you have other topics you'd like to hear more about, let us know. But until next time, we look forward to seeing you again on Gimme Some Truth.
Walkner, Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner, Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.